Hi, Finn. Appreciate you hopping on, man. Shout out Charlie Ma for making the intro. I guess just to set the stage for people who aren't familiar with you or Nebular, can you just give the quick background, elevator pitch on what you're working on today?
Yeah, sure. So like Nebular, it's like a $30 million LGP fund. I'm based out of New York City, investing all across the US and Europe, but pre-seed and seeds, red checks anywhere from like 500K to 1.5 million. Typically like lead, co-lead of pre-seeds, like at seeds, like usually like part of syndicate, trying to be part of bigger syndicates. And I sort of take this viewpoint of like a lot of the edge and the alpha of like having a lead check seed fund is trying to like build your own conviction in categories that you think are like coming down the line in the future. Like what's really interesting today is like hyper competitive. There's many people trying to pursue the same thing, and there's no reason why you starting a company in those areas like you can't be really successful. But usually the most obvious ideas have like the most obvious founders pursuing them, like take like AI customer support with someone like Brett Taylor. And so my kind of reason for existing is like finding these categories and finding these founders that are like a little bit ahead of the curve. And that's sort of Nebular and like where I'm at right now.
Nice, man. I mean, prepping for this was relatively easy just because you put out a lot of writing, either on your personal Twitter, or on your website. But one of the things that I pulled up first, it was a tweet that you put out recently. And it was this idea of the risk of founding and getting funding being the lowest it's ever been. I'm curious, like from your seat now, or from your seat today, when you're evaluating founders, especially the pre-seed, how are you trying to discern who's real versus who's just doing it for a lack of better options?
It's a good question. I think it's a good thing generally that like it's both a good and bad thing that like the risk of starting a company is like lower than it's ever been. Like YC has like, they're gonna put through there's gonna be like 700 companies a year come through YC. There's like a lot of other accelerator programs that used to be kind of shitty have kind of got their act together and actually are like putting out really interesting stuff. And accessibility from angels, micro funds. There's just so many more VC funds than there's ever been. The challenge with that as well is like also like if you are the type of person that like looks like you could start a company. So like you worked at Palantir, you worked at SpaceX, you worked at Tesla. There's like a kind of playbook to run on, I'm going to pick this category, I'm going to pitch it in this way, and I'm going to be able to raise money. I think you just, in terms of discerning like who's for real and who's not, it's like I always kind of ask founders, I'm like, I don't really care about the pitch initially. It's kind of like, why are you doing this? Like, what are you interested in? Like, is this a problem that you're just like, you know more about than anyone else and you're super excited to get into it? Are like, is the reason you had to start a company because you're just like kind of unemployable, but like actually unemployable? And I think so much of it comes down to like ultimately venture is like it's a people business. Like you're trying to pick really interesting people with very high slopes. And often like people spend a lot of time talking to people about their business model and their deck. And what you kind of want to get a better handle on is like who they are as people and like why they are doing this. And so I think in this current environment, that's the thing to be like extra aware of in assessing founders is like spending like almost less time on the business and more like why they're pursuing this business in the first place. And various firms have done this in different ways, like Hummingbird have a whole thing where like we psychologically analyze founders to like make sure that they have some sort of like deep psychological trauma that's motivating them to do this and will drive them to be successful. And I'm like, power to you. Like I think that's a very good way of discerning between people today. But it's when everything's like a bit too easy. I think that's the risk of like, you know, building companies is just really hard and it gets really hard over like it doesn't get easier over time. Like even when you have hundreds of employees, you're worth $1 billion, like your problems are just bigger than they were than when you were starting out and you had nothing. And so I think it's figuring out people who, when things get hard and don't go the way they want them to, are actually going to be like, okay, now I'm going to double down. That's sort of what I think you have to be extra aware of.
Yeah, I feel the same way. I feel like it's only getting harder to find those types of people that have like, and usually I feel like the problem stem from personal pain points. at least for like the solutions they're building. But yeah, I feel like in an era where everybody's just talking about vibe coding and like creating these products in a day, it's like, all right, that's great. Like it's great that it's becoming easier to build a product, but like what's actually gonna keep you sticking around? Because I think things that actually compound, like time in the market, is what really matters the most. And it's like what's going to keep you sticking to one project versus just jumping around to a million. So I'm trying to think through that as well. Let's see. I had another question about this idea of narrative being the new oil and hearing actual information or real opinions expressed in any public forum just becoming increasingly rare. I'm curious your thoughts on it. I know you wrote a piece about this, just titled "Everyone's Talking Their Book." But I mean, I feel the same way, and I feel like the best information I get, at least on the investment side, is just from people that I've built closer relationships to and I'm on a texting basis with versus the stuff that just gets promoted on social media or even newsletters. So I'm curious your thoughts on that idea.
I think it's so like the channel that has been like most effective in terms of distribution and like call it like the last 18 months has definitely been the like go direct, like flood the zone, podcast, newsletter, posting, like very, very high volume. And like the algorithm rewards you for talking consistently with like similar tone and also like talking about the same subject areas. And it also rewards you when like multiple people all align in the same tone with like the same concepts and I think that's like part of where we've got to now on this like everyone's talking their book because like you get rewarded in terms of distribution for being on message and getting other people to all be aligned around your message and also just like for being very high volume. I think the problem with that is like it's like to your point, like people kind of recognize it now and it's like nobody believes anything. There's like a lack of authenticity around like where are like who's actually being real. I think there's always like a counter swing to what is going on in the market. Like, what works and what ends up being the next thing that works ends up being like usually like some degree of like the other side of the coin. But I still advise founders, it's like, look, you need to find a message and you need to start posting about it. And ideally, like that message is like as authentic to you as it can be. But you can't ignore like what works and how distribution, like, it's so noisy out there and like breaking through that noise is just always going to be a part of being good at the job. So it's like finding a message, being consistent about that message, and ideally making sure that message is like true to you and authentic. But it's hard. Like I think you're just gonna see more and more like real information gets traded in group chats and like there's gonna be a social premium on like being in those sort of like private access groups. That's been another trend that's kind of accelerated over time. But I don't know if there's any going back from that.
Yeah, I mean, I feel the same way. I mean, that was kind of the genesis of our business of just like finding people on other platforms, like giving them a reason to build like smaller communities or breakouts where they can build deeper relationships with people and trade information that way. I think also the problem, like to one of the points you made earlier, just like putting out volume is like if you put out volume, like you should be, at least in terms of like putting out volume of content, you probably should be increasing the quality of the content. But typically by the time that you like get to something right or correct, a lot of the audience has already tuned you out because they're just getting flooded with information as is. And so that's something we've tried to balance too. I'm just trying to think through the right cadence. I don't know. I don't know if there's a one size fits all solution to it.
I don't think there is. I think it's like if it's not something you enjoy and you're not, and there's not a message that you want to amplify, I think it's like you'll lose the consistency over time. And then once you lose the consistency, it doesn't work at all. And like I struggle with this a bit, like on the venture side, where like what's the message I want to be putting out there? Like I don't want to sound like a broken record, but the message I want to put out there is like, not all of the best companies are going to be obvious that they're the best companies on day one. And that like the early stage company formation process is messy and that like information is imperfect and in silos. And like there's arbitrages still to be had and like having unique opinions and being willing to take a lot of risk. But like there's a lot of nuance in what I just said there that's like hard to be repeatable in like a content strat to have repeatable in a content strategy. I don't know what the next evolution of this is. But it's just something I think you have to take a view on and you have to sort of do some experimentation and stay out there to, and like, I think the thing of like we're just gonna be good and not make noise. I just don't know if that worked. The whole Thrive thing in the early days was like, we're not gonna have a website. I think, there's other really good firms like, there's like Definition now is doing something similar. Blue Yard is like another firm that like don't make a lot of noise about themselves. But I think it's like nobody thinks you can just not engage at all. It's like finding your way of engaging that's authentic to you, I think is the thing that everyone's like, okay, that's actually the problem that you're trying to solve for now.
Yeah. I think the issue, if you're going to take the approach of not promoting yourselves publicly, that means you're going to have to do it privately. And I think the issue with doing it privately is like privately doesn't scale. So
Yeah.
like publicly, at least it scales and you can have visibility from a lot of different angles. Like privately, you just got to have literally hundreds of conversations every single week, just become top of mind for people. And even then, like it's not a guarantee. And so, yeah, I respect the firms that are doing that approach because I also do feel like like you're selling part of your soul, just like constantly putting out content for the sake of putting out content. But I just feel like I don't know, it's so difficult to do the alternative, that all of us are now on this content treadmill.
For sure.
I want to talk about this other idea that you put out in a piece called Looking Right versus Being Right. And that is this idea of looking right can make you start feeling right as opposed to the goal of being right. And within that piece, you gave a couple examples of firms, just like bubble periods, but there's a couple notes in there of just Benchmark being really great, being long duration traders. And then you gave an example of Sequoia being great company builders. I'm curious, just like if you can unpack that a little bit more, of what you meant by that, just so other people can have a better idea.
Um, I think this is like something that I've learned over time from like talking to a lot of different GPs is however a firm becomes successful tends to be the strategy that is like what they stick by over time. So you have someone like Green Oaks where like have done incredibly well out of concentration. And so their whole shtick is concentration. You have firms that have done like very well through having like, a small number, like small checks, like Box Group and a whole bunch of different companies and like indexing the top quartile of the cohort. And I think with Benchmark, like, the origin story of Benchmark is like Webvan and eBay. And like both of those businesses were like Webvan, like eventually was basically a zero. eBay obviously like eventually like became well, through the PayPal deal and then like being spun off and sold. But like where Benchmark really made their money was by trading out of eBay during the dot-com boom. While you take someone like Sequoia and like where Sequoia made a lot of their money was in like the company built like Cisco as like a long-term durable company. Like in terms of, I actually think they did trade out of Apple after the IPO, but like investing in Apple, like Genentech was another one that I'm pretty sure was a Sequoia like long-term company built thing. Like Electronic Arts was like another one that basically like there was a lot more of these businesses that have driven massive success for Sequoia are companies, in the particularly historically, are companies that are still around today and are like massive businesses. While like if you look at some of the businesses historically the Benchmark invested in and done very well, like they kind of came out of it. And I think it's the reason I brought that up in that piece is because there is an element of VC that is trading versus company building. Like there can be a good time to get into companies and there can be a good time to get out of companies. Um, and I think if you take that mindset of like, no, like we are focused on the ultra long-term value creation, that is, I think, how you generate like incredible like returns like beyond anyone's wildest dreams. But most venture firms aren't, their businesses aren't structured like that. Like you can't hold on to these assets for like 15 to 20 years. And I think that's the piece where I brought it up is like whatever, where you find success is where you will search for success in the future. Um, And that was kind of the bit around the like Sequoia benchmark piece. I think on the trading piece, it's more so like, if you were in figure robotics and you were in the like first round at $1 billion valuation and like the SPV now is at 43 billion, like you should probably be thinking like a trader and being like, maybe I should actually take some money off the table. Um, but I think it's really hard because like the point I was making about like looking right versus being right, like if you give a GP two options, like one graph, I have this in the piece where it's like you've two graphs, you've like TVPI on the y-axis, time on the x-axis. Like, if you've like your TVPI stays really low until year 7 and then rips and you return the fund 3 times over, it doesn't really matter because it's going to be really hard to raise new funds for that first 7 years. And like maybe you make it, maybe you don't. Versus if you have another fund where your TVPI goes like stratospheric in year 2, then it's going to be and it goes all that way until year 7 and then crashes in year 7. It's not really going to matter because you're going to have raised fund 2, you're going to have raised fund 3, and you're going to be in a position where you've given yourself enough chances to be successful. Um, and I think it's like a different mindset. Like it is easier to invest in a way that will make you look smart than it is to invest in a way that will make you money. Um, and like it's not that the two are mutually exclusive, and I think you have to have a viewpoint of like blending both in any fund manager or like any portfolio construction. But it's like another factor to like building venture firms is hard. Thinking about strategy is hard. Like a lot of the current ecosystem pushes you towards doing stuff that like investing in Brett Taylor at $4 billion, like you will look smart for doing that. Like I think you should make money, but you will definitely look smart. And so there's all of these preferences. And I think like probably the highest alpha trades in venture and highest alpha investments are things that you do that actually have a real chance of making you look like an idiot. Because that's the stuff that like it's much harder for someone to do if they're at Sequoia or Lightspeed or a GC, because putting your neck on the line, it's like you've got such a good thing going. Like, why would you put your neck on the line for something that you think is high upside, but also like has actually like real material downside?
Yeah, no, 100%. Do you follow Jeremy Giffen at all?
Jeremy, give no.
Giffen, Giffon. He used to work at Tiny Capital. He has his own firm now. I think it's called like Octave. But one of the smarter investors that I listened to, and he had a piece on Invest Like the Best a couple years ago, where he gives these examples like the safest bet. Well, actually, not the safest bet. The smartest bet, if you look back 15 years, is to park money into Bitcoin and big tech stocks, but doing that would be perceived as boring. And yet instead we have all these people that are like putting money into really complex strategies, whether it's venture, private equity, hedge fund, you name it, distressed assets, charging fees on it to underperform the S&P, which underperforms just like the simple strategy of putting money into Bitcoin and big tech by a massive margin. And I think his takeaway from that was that people would rather value the perception of being smart rather than the reality of being right. Like they price one lower than the other.
Oh, 100, but like justifying your existence, like it's hard to justify your existence if you're a new manager parking your money in Mag 7 and Bitcoin. People would just be like, what the fuck are you doing charging me money? And I'm like,
Yeah.
I'm charging you money to prevent you from selling when I don't think you should sell. And I think people have like a mindset around like, no, I'm paying you to buy. I'm not paying you to not sell. Um,
Yeah.
there's a whole lot of dynamics like that in like I think the investing business that make it like doing the boring thing is also like often the right thing. Um, but is the boring thing like, can you justify it? Can you do it? And so like in the current market, like maybe like look at the OpenAI trades, like the boring thing was probably to just put a ton of money into OpenAI and Anthropic. And like it was kind of obvious 2 years ago that these were going to be big businesses and just doing whatever you can to try to get into those companies. But like the challenge is for most people, your strategy is like, I ask myself this question sometimes where it's like, is it always a good time to be a seed investor? Like, no. But
Yeah.
like I'm paid to be a seed investor. And so, and like, is it always a good time to be deploying money? Like, no. But like timing the market is really difficult. And so you just kind of have to consistently do it over time. But yeah, it's all of these dynamics of like, it's also like everything is kind of easier in retrospect where like looking back 15 years and being like yeah the obvious trade was Bitcoin and Mag 7 and then it's like if you held for all 15 years but like you also would have been up 3x like
Right.
you know 10 years ago and like if you had a 3x would you have been like hey actually I think I'm going to sell everything and so this is like another thing I think investors are like extremely good at is like everyone is a revisionist historian
Hmm.
where it's like, if you look at the retrospective, it's like, oh, that was obvious. It's like
Yeah.
the Trump trades of like European defense stocks. It's like that was obvious.
Yeah.
But like actually going and doing it. And now the question is like, you know, at like the Societe Generale, which is like a French bank, is like up like something ridiculous, like 60, 70% in the last 3 months. And it's like not a good bank. Like it's poorly run. But so the question is now, do you sell that? Do you lock in your trades? Is like are tariffs going to continue to accelerate that trade? So I know we've gone on a bit of a tangent here, but it's always the like, I think you're right in that it's like I think the buying and selling aspect of investing is like under discussed, particularly on the private market side, because like the upside of venture used to be that like you just couldn't sell and it turned out that these secular markets like continued to go up and so like by preventing people locking in gains because there was no liquidity on the way up you actually resulted in like some massive outlier outcomes
Yeah.
but
And
now there probably is more liquidity and the question is like that's probably a good thing for some people and then probably also a bad thing for others.
totally. Yeah, I feel the same way. I mean, I feel like I have a pretty strong belief that the secondaries market is going to be continually used as a way to give managers DPI. So you actually have like a mechanism to sell because I think up until recently, like you put all your eggs into you're either going to have to IPO or have M&A in order for you to give some distributions back to LPs. But I think over the last 5 years, LPs got pretty frustrated with not getting distribution. So it's just been like more and more of a forcing function for alternative um, ways to get liquidity. I think liquidity can come in a lot of different ways, but it just seems like a lot of these GPs are starting to use secondaries or other means to give just take some money off the table, and that introduces an entirely new mental model in terms of like knowing when to sell, knowing what to sell, like timing it all. It's just another thing you got to balance.
No, for sure. And it's like, I don't, yeah, it's like another skill that's required in managers that was not required 5 years ago. I think there has always been a market for secondaries in like the very, very best companies that are like, I think Fred Wilson's whole thing, like they sold down part of their Twitter stake before the IPO to lock in a fund return. They sold like a third of the stake to lock in returning the fund. Um, but like usually that was the thing you could do. It was like the pre-IPO round.
Yeah.
Like now, I fully believe like there are going to be businesses that end up being zeros for the growth investors that seed investors will probably return their funds on. And being intellectually honest enough with yourself to be like, oh, okay, this is a momentum business because there's always the downside of like, you know, what if this turns out to be the one that goes all the way? It's another consideration I kind of think you have to have right now.
Yeah. No, I feel the same way. All right, man. I know we're at time here. I don't want to eat up.
I can run another 5 minutes. I got to run it over time if there's anything
Okay.
else.
I guess the last question I had, I mean, you had a piece on LP expectations versus VC realities. Can you just kind of break down some of the main ideas of like what you're hearing on the LP side versus some of the stuff that you're seeing on the GP side and like maybe where some of that disconnect is coming from?
I think it's like like, and I believe this, like investing in a like a small venture capital fund that has like a 12-year liquidity time horizon, like you have to believe that it can be like a 5x net fund. And like, that means returning like 6.6x gross, depending on your fee structure. And like that to me I kind of see it being like, so if you have a $20 million fund, you probably have to return like 135 to your LPs to like really justify being invested in that fund. So in your $20 million fund, you're looking to get, so to create 130, capture $135 million of enterprise value, you need to own, 13.5% of $1 billion company. So like no $20 million fund is owning 13.5% of a $1 billion company at exit. It's much more likely your $20 million fund owns 1% of a company at exit, of like a company that works at exit. And the reality of that is, okay, now you need to own 1% of a $13.5 billion company. And it's just as the markets become more competitive and like ownership has got compressed and entry prices have gone up, um, I think like LPs worry about risk and concentration, but on the flip side, they're not stretching people. Like, it's like the mismatch in expectations is the only way to generate the kind of venture returns that you're looking for is either being like you have to be in one of the greatest companies of all time. Like there are not that many $10 billion plus outcomes, particularly ones that you can get into at the earliest stages. And so the only way you can really get that kind of returns profile is by taking more and more risk. And I think the problem is like more risk is scary. Like there's slower timelines to markups. There's like more write-offs. And I think that that's where that misalignment kind of comes from is, and there are some people investing in venture, like particularly now, like I think no one investing in GC's new fund is expecting 5x net. Like they're not probably expecting 3x net. They're looking for like a 12 to 14% IRR relatively consistently over the next like, 10, 15, 20 years. And so I think that's also the challenge of like the mismatch of like the types of LPs that are investing in small funds are still investing in broad strokes the same asset class as GC. Like you're competing against those people are marking you up, but they're expecting a 25% IRR. And so you have this like mismatch of cost of capital across the whole asset class right now. And I think that's where the like mismatch is right now. It's like risk tolerance to like required risk premium and like cost of capital of like parties that are ultimately competing in the same pool of assets.
Yeah.
And so I think it probably means that like generally the median return in the asset class goes down. The average, like there's always going to be all-time bangers. That's the way, like it's a hits business. Um, but the question is like, can you reliably be in all-time bangers while having disproportionate ownership relative to your fund size? That's the like, if you could solve that, it's like the holy grail of venture. But I think like a lot of strategies are like hard to set up for that kind of goal and that kind of return.
Yeah. 100%. I feel like you see all these, yeah, there's like a lot of things to unpack there. I think you see all these mega funds becoming LPs now, like they're the kind of dedicated fund of funds vehicles where they're LPing the next generation of emerging managers. They can kind of fill the void. And like those are they're like call options for these funds so that they can get information rights on the portfolio, write larger checks themselves with some type of information arbitrage. I could talk like venture strategy and like venture macro stuff all day long, but I think it's just like it's an interesting period. I guess we'll have to see what all shakes out.
Yeah. And I think it's like, I think it's a good time to be starting a new fund. Like, the advantage you have when you're starting something new is like ultimately you like have a lot less to lose. Like you can take real risk, you can put yourself in different situations. I think the like danger of being a new fund manager right now is like reversion to the mean, because like the mean is not going to be good. Like the mean is not going to be good.
Yeah.
Um, and so I think that's always the way. It's like I'm like just trying not to be too smart.
Yeah.
Like it's a hard business, but I think it's one of the most like it's I mean it's like the cutting edge of the next generation of like hopefully the biggest companies in the world. I don't think you can get like a much more interesting place to spend your time investing than that.
Yeah. I totally agree. All right, man. I'll let you run. This has been a ton of fun. I really appreciate it. And I'll get back to you once we get this cleaned up and ready to send out.
All right, great. It was really good to meet you, Aaron. And yeah, hopefully let me know next time you're in New York as well.
I will. We'll hit you up.
Awesome. Later, man.
All right, see you, Finn.